Hello, and welcome to Your Money, Your Way. Today, we're doing a much deeper dive into the latest numbers from a household name in Singapore, the supermarket giant Sheng Siong. On July 30, 2025, Sheng Siong dropped their business update for the first half of fiscal year 2025. We're going to go beyond the headlines and really analyze the details. So, are they checking out with a cart full of cash, or are rising costs leaving their wallet a little light? Let's unpack it all. But first, our disclaimer. This video is for informational purposes only. It is not financial advice. Always do your own homework and consult with a professional before making any investment moves. All right, let's get to the good stuff. Sheng Siong kicked off 2025 with some very solid top-line growth. Revenue for the first half of the year hit an impressive $764.7 million. That's a 7.1% jump from the same time last year. Now, let's follow the money down the income statement. Gross profit grew even faster than revenue, up 9.6% to $235.6 million. This is a fantastic sign. It means their gross profit margin improved, climbing from 30.1% to 30.8%. The company credits this to selling a better mix of products and their efforts to manage rising operational costs. But here's where the story gets more complex, and we can see the pressure they're under. Take a look at their operating expenses. They surged by 12.2% to $158.7 million. This is a key point. Their expenses grew significantly faster than their revenue. The financial statements give us the breakdown. Selling and distribution expenses, their biggest cost category, jumped by nearly 14%. The primary driver was a $12 million increase in staff costs for their supermarkets, a direct result of opening new stores and paying out higher bonuses for good performance. This is the headwind they are fighting against. So what's the final score after this tug of war between higher profits and higher expenses? Net profit landed at $72.3 million. That's still a respectable growth of 3.4%, but you can see how those rising costs ate into the potential. Their net profit margin, therefore, saw a slight dip from 9.8% to 9.5%. They're making more money, but each dollar of sales is slightly less profitable than it was a year ago. So, how exactly did they pull off that 7.1% revenue growth? The report breaks it down for us clearly. The big story here is new stores. In the first half of 2025, Sheng Siong's 11 new and comparable new stores in Singapore were the absolute star performers, contributing a hefty 6.4% to revenue growth. In stark contrast, their 69 existing mature stores saw sales grow by only 0.1%. This shows that without new stores, their growth would be nearly flat. Expansion isn't just a strategy. For Sheng Siong, it's a necessity. And this is where it gets really telling. Let's look at how they stack up against the competition. One of the charts in their presentation compares Sheng Siong's sales growth to the national benchmark for supermarkets, and the results are striking. While the national average has seen wild swings, including a massive 13.3% dip in February, Sheng Siong has consistently outperformed. In the second quarter of 2025, Sheng Siong posted a robust 6.8% growth. This shows incredible resilience. They aren't just growing with the market, they're taking a bigger piece of the pie. Okay, that's the snapshot for the first half of the year, but what about consistency? Let's zoom out and see how their performance has been over time. This becomes crystal clear when you look at their profitability trends over the past few years. You can see that despite all the economic noise, their gross margin has been remarkably stable, hovering around that 30% mark. Their net profit margin has also been highly consistent. This tells us that management is skilled at navigating challenges and protecting profitability. What we're seeing in 2025 isn't an anomaly. It's a continuation of a well-managed performance. Now, let's talk about what might just be Sheng Siong's secret weapon, their fortress balance sheet. We know they have zero debt, which is already amazing, but let's dig a little deeper. Their total assets stand at $924 million. Looking at their long-term assets, you'll see $303 million in property, plant, and equipment, and a $30 million investment property for long-term appreciation and rental income. But the real kicker is their current assets. Out of $475 million in current assets, a massive $367 million is in cash and cash equivalents. This is their war chest. It gives them the ultimate flexibility to acquire new locations, invest in automation, and weather any economic storm without needing to borrow a single dollar. And just as important is how they manage their liabilities. Their current liabilities actually decreased by over $21 million since the end of last year. The financials explain this was mainly due to a $23 million reduction in trade payables, as they paid out accrued bonuses and made timely payments to their vendors. This is a sign of excellent financial discipline. It all paints a picture of a very, very strong foundation. So, with all that in mind, what's the game plan moving forward? The company has laid out a clear, multifaceted strategy. They know competition is fierce and costs are rising. First, they will defend their margins by improving their sales mix with higher margin products and increasing their selection of house brands, which appeal to budget-conscious shoppers. Second, they will attack costs. They are pushing forward with initiatives to automate work processes. This is their direct answer to the tight labor market and rising staff costs. And third, they will continue to seek growth. They are actively pursuing expansion with 3 tenders already pending results, and another 3 HDB stores are expected to be released for tender within the next year. This shows a healthy pipeline for future growth. As a sign of their confidence in this plan, the board has once again proposed an interim dividend of 3.20 Singapore cents per share, the same as last year. So, to wrap it all up, let's frame this as a bull versus bear case. The bull case for Sheng Siong is clear. They are a market leader that's gaining share. They have a fortress balance sheet with zero debt, a huge cash pile, and they are a consistent dividend payer. Their management has proven they can navigate tough environments. The bear case, on the other hand, points to the margin pressure. Operating costs are rising faster than revenue, and their growth is heavily dependent on the capital-intensive process of opening new stores. Any slowdown in their expansion could significantly impact their top-line growth. Ultimately, Sheng Siong's story is one of a strong, disciplined company, successfully executing an expansion plan while fighting against macroeconomic headwinds. And that's our deep dive on Sheng Siong's latest earnings. Remember, this is just for your information. What do you think of their performance and strategy? Drop your thoughts in the comments below. And don't forget to hit that like button and subscribe for more deep dives like this. Thank you for watching.